Welcome back to the Deep Dive. If you've been following the financial news lately, it certainly feels like the market is moving at the speed of silicon.
It really does. Everything seems to be driven by technology, specifically this artificial intelligence revolution that's unfolding.
And our mission today is really custom-tailored for you, the learner. We're trying to provide the ultimate shortcut to understanding the powerful forces that are shaping global finance right now.
Okay, let's unpack this. Our sources are focusing intently on the runaway powerhouse of the market. That's the information technology sector.
Right, and specifically, we're zeroing in on one investment vehicle that just perfectly encapsulates its dominance.
The Vanguard Information Technology ETF, which we'll just call VGT.
Exactly. This fund is where the majority of the concentrated AI money is flowing, and we really need to understand the structural reasons why it's been so successful.
That's right. This is a highly specific deep dive. We're examining the VGT, what it holds, why it has so consistently outperformed, and crucially, what its highly concentrated composition tells us about the current structure of the AI economic revolution.
Because it's not enough to just name the winning companies.
No, you have to dissect the underlying fundamentals that make their growth seem almost guaranteed for the next couple of years.
And when you look at the performance numbers, they are, frankly, staggering. Let's set the stage a bit with the broad market. As we wrap up 2025, the S&P 500 index,
Which is the main benchmark for large U.S. stocks.
right, it has posted a return of 17% for the year. And that is a fantastic result. I mean, it's comfortably above its historical annual average of about 10.5%.
It is a phenomenal year. But here is where our first real aha moment comes in.
Go on.
An investor who chose to put their capital into the VGT at the start of 2025, they wouldn't have just seen 17%, they would have seen a return of 23%.
23%, that's a 6-point advantage.
A 6-point advantage over the broad index in a single year. That is a level of alpha that, investment managers dream about achieving. It's a massive outperformance.
And this isn't some flash in the pan. We are not talking about a single look a year here.
Absolutely not. If you zoom out and look at the historical track record, the trend of dominance is actually stellar. Since its inception back in 2004, the VGT has beaten the S&P 500 every single year.
Every year. That is sustained multi-decade superiority.
It is. To put that in perspective, the fund's compound annual growth rate, the CIGR, since 2004 is 14.1%.
And the S&P 500.
A respectable, but, comparatively sluggish 10.4% annually over that same two-decade period.
Let's just pause on that difference, because 14.1% versus 10.4% might sound small, but over 20 years, with compounding, that difference is enormous.
Oh, it's life-changing. It's the difference between a comfortable retirement and potentially working an extra decade.
So we know VGT is a consistent winner. It's an ETF that tracks the IT sector. It holds 322 different stocks. But here's the irony. You don't really need to understand all 322 of them.
Not at all.
What's truly striking here is just how concentrated that performance really is. The 23% return this year, it's driven by a shockingly select few companies.
It is. Our sources show that the top 10 holdings in VGT make up a staggering 59.1% of the entire portfolio.
Almost 60%.
When you see that level of concentration, almost 60% of the fund on the shoulders of just 10 corporate giants, it tells you the entire structural story of the AI revolution.
How so?
Well, building AI requires immense capital, scale, and proprietary hardware. That means only a few companies can truly dominate that infrastructure layer, and the VGT just reflects that reality perfectly.
If we break it down even further by subsegment.
We see exactly where the money's flowing. The VGT invests across 12 different IT subsegments, but one stands head and shoulders above all the rest. Semiconductors.
The chips.
The physical core of the AI build-out. It has the largest weighting by far, at an astounding 32.1% of the entire fund.
Let's run through those top holdings, because
Right.
their scale is what defines this. We have to grasp not just the percentage, but their sheer size.
Okay, the top 5, as of late November 2025, they're very illuminating. Number 1 is Nvidia, commanding a massive 16.61% of the portfolio.
And this is a company with a market cap of, what, $4.4 trillion?
$4.4 trillion. The scale is almost incomprehensible. Number 2 is Apple at 15.31%. 3 is Microsoft, which accounts for 12.43%.
It's just amazing that even as trillion-dollar companies, Apple and Microsoft have a smaller portfolio weight than Nvidia right now. It shows you how dominant the hardware supplier is.
Exactly. Then the fourth largest holding is Broadcom at 5.23%, another infrastructure giant sitting at a 1.6 trillion market cap.
Okay, and number 5.
Number 5 is Palantir Technologies at 1.85%.
Yeah, that's interesting. I think some listeners might expect a bigger name there, maybe like Salesforce, the CRM specialist. Why Palantir?
It really connects back to that core infrastructure focus. Palantir, while it's technically a software company, it specializes in massive data integration and AI deployment for, huge customers like governments and enormous corporations.
So it's a pure play bet on organizational AI adoption.
Precisely. That makes it highly valuable within the fund's AI thesis, even if its market cap is smaller than some of the others.
That makes sense. And to complete the top 10, we have AMD at 1.73%.
Another crucial chip designer. Then Oracle at 1.67%, Cisco Systems at 1.52%, IBM at 1.44%.
And finally, Micron Technology at 1.33%.
That's your top 10.
So we've established the names, but let me play devil's advocate for a second. Doesn't that high concentration, nearly 60% in 10 names, fly in the face of every diversification rule we talk about?
That is the essential question, isn't it? And on the surface, yes, it violates those norms.
Well, so what happens if one or two of those behemoths stumble?
Well, the sources suggest this concentration isn't a bug, it's a feature. It reflects the current reality of technology investment. The belief is that the market is rewarding these companies because they aren't just tech leaders, they are technological bottlenecks.
Bottlenecks, explain that.
You cannot build the AI economy without the resources they provide. It's just not possible. And that gives them inherent pricing power and a stability that other sectors just lack.
Okay, let's pivot and dive into the fundamentals here. We need to separate these big players into two camps. The old analogy, right? The ones selling the shovels and the ones running the gold mine.
Precisely. Let's start with Focus A, the hardware suppliers. This is Nvidia, Broadcom, AMD, and Micron Technology.
The shovel sellers.
Exactly. They supply the absolutely critical physical components, the specialized data center chips, the networking gear, the high-speed memory, everything you need to train and run AI models.
And the key insight driving their returns is?
It's simple supply and demand. The world's hunger for AI is growing faster than their ability to manufacture the chips. They all have more confirmed demand right now than they can physically supply.
So this isn't just height, it's a physical bottleneck.
It's a fundamental physical bottleneck. Their revenue model is high margin, they sell a physical product, and they control the only viable supply. That gives them all the pricing power.
Which translates directly to that rapid revenue growth in their data center segments.
Correct. And now we flip to Focus B, the cloud and platform providers. Here we're talking about Microsoft and Oracle. These two are the enormous customers of that first group.
They're buying billions of dollars worth of those AI chips.
Billions. And they are building the physical data centers. And their business model is where the money truly compounds. They take all that hardware.
And they don't sell it.
They don't sell it. They make the computing capacity available through their cloud platforms as a recurring service. Other companies then rent that capacity to develop and deploy their own AI software. It's the operating system for the entire AI economy.
That model just sounds so much more predictable than selling a one-time product.
It is, and the data confirms it. What's truly fascinating is that both Microsoft and Oracle have enormous order backlogs.
Backlogs, so they've already sold the capacity.
They have confirmed guaranteed revenue from customers who have signed contracts to rent future capacity they can't even fulfill yet because the data centers aren't fully built.
Wow. So as the hardware suppliers catch up, Microsoft and Oracle will bring that capacity online and just turn those backlogs into guaranteed revenue.
It's a direct translation into accelerating revenue growth.
So the dominance of VGT isn't just about good stock picks. It's about owning the companies that control the physical parts and the distribution channels for the next generation of computing.
And we should mention, the fund does include other key players, even if they're not in the top 10. You've got CRM specialists like Salesforce, cybersecurity firms like CrowdStrike and Palo Alto Networks.
So it captures the whole AI world, from the hardware all the way to cloud security.
Which naturally raises the biggest long-term question. Is this extraordinary growth purely dependent on the current AI boom?
What happens in 5 years when the rush for chips tapers off?
Exactly. When the physical bottleneck is solved.
Well, looking at the history of the tech sector gives us a pretty good answer. While AI is driving returns now, the sources remind us that this sector is incredibly adaptable.
It really is. A decade ago, it was the smartphone revolution. Before that, enterprise software. Before that, the cloud itself. This sector is engineered to pivot.
And that ability to pivot is essential to the whole VGT thesis.
It is. The sources project that when the current AI boom matures, other advanced technologies are already waiting in the wings to become the new dominant sources of returns.
We're talking about huge infrastructure-heavy fields.
Things like quantum computing, robotics, and the widespread deployment of autonomous vehicles. All of these require a similar, concentrated investment in hardware and cloud capacity.
So let's synthesize this for the near term. Looking ahead to 2026, the picture seems remarkably clear for VGT.
Yes, highly positive. We see two primary forces driving continued outperformance.
First, that continued growth in AI data center spending is going to keep fueling the hardware suppliers.
Right. Nvidia, Broadcom, AMD, Micron, they are still catching up to existing global demand, so their revenue runways are still long and steep.
And second, the cloud divisions at Microsoft and Oracle are practically guaranteed to see accelerating revenue growth.
They'll be fulfilling those enormous backlogs, bringing new data center capacity online, and turning those booked orders into cold, hard revenue.
So all signs point to this Vanguard ETFs likely beating the S&P 500 yet again next year.
It seems very likely. Given its history, its targeted exposure to the essential infrastructure, and that built-in revenue acceleration, it stands as a really powerful consideration if you're looking to make sure your portfolio is exposed to the core of the AI revolution.
That brings us to the end of our deep dive. To recap the core takeaways, we established VGT's historical dominance, with a long-term growth rate that just crushes the broad market.
We analyzed how that performance is driven by a heavy structural reliance on the top 10 AI infrastructure players, those technological bottlenecks.
And fundamentally, we saw that the current demand is powered by enormous backlogs for computing capacity at the major cloud providers, which is a powerful predictor of future revenue.
Now, here's a final thought for you to consider, to mull over. We've established the tech sector's versatility, its ability to pivot from one disruptive technology to the next, from smartphones to cloud to AI.
It may be to quantum computing or robotics next.
Potentially. So given the high concentration of the VGT portfolio today, how soon before one of those future technologies, let's say quantum computing, fundamentally disrupts the business model of one of the existing top 5 players?
That's a great question.
Is VGT's broad mandate covering the whole IT sector really enough protection against that kind of internal technological cannibalization? Or does its reliance on those 10 giants right now make it vulnerable to the next great pivot?
Something to think about. We hope this deep dive gave you the clarity and context you needed today to understand why the VGT is dominating the market. We'll be back soon with more insights from the sources you share.